It's all about the one big beautiful bill on this episode of the Capital Stewards Podcast. Some would say it's the hugest, most beautiful bill ever, and we're going to talk about that. Will it be good for the economy? What about the deficit? Is it $4 trillion or is it something less than that? And the second half of the podcast, I'll cover what the big beautiful bill means for your taxes and what tax planning steps you really should think about as we move into the second half of 2026. So a lot to cover. Let's dive in. Let's talk about the tax bill. Before we get into the current legislation, I always like to set the table on sort of the U.S. fiscal situation correctly. For some of you, this is going to be like beating a dead horse, but it's important, so I'm going to talk about it anyway. You can skip ahead if you don't want to hear this little bit of a soapbox again. But most people get their information on the U.S. fiscal situation from the evening news, which is usually tilted one way or the other. Two things are true about the U.S. fiscal situation. The first is that we have a spending problem, not a revenue or a tax collection problem. U.S. revenue has been very steady, about 17% of GDP since the 1940s. And that's where we sit today. You can see that on the green line of the chart. Spending, however, exploded higher during the financial crisis of 2008, then again during COVID, and it continues to break higher even though we're not in a crisis. Spending should be somewhere between 18 to 20% of GDP during good economic times. We don't need to have a completely balanced budget, but we should be closer than not during good economic times so that we can spend to stimulate the economy when we do have those big crisis moments. So you can argue that we should raise tax revenue to a higher level than it's ever been. That's a political argument. You can argue that we should have even more spending than we have today. That's also a political argument. What you can't argue is at sort of the current levels relative to the size of the economy and relative to history. Revenue is currently very close to historical levels. Relative to the size of the economy, government spending is significantly higher. The second part of this conversation always goes into sort of who pays and who does not pay their fair share. And that conversation is, some of it's already happening in the media, some of it will come through the rest of the year, I'm sure, with the tax hikes for, the middle class and the breaks for millionaires and billionaires. I can hear it coming now. So let's look at the tax data. These charts show U.S. households by income quintile. You can see in the bottom row, the dividing income lines there between the five groups. You can kind of figure out where you are on the table. On the left, the lowest four quintiles all have a higher share of income than they pay in taxes. The only group that shoulders a greater burden of the taxes than their share of income is the richest 20% of Americans, or that top quintile. They pay 81% of the taxes, but they only earn 55% of the income. You might ask how it's possible to have a negative share of taxes or a negative tax rate. That's because this takes into account the refundable credits and deductions, so you can actually get more back from the government in income taxes than you pay in. And that happens in the lowest quintile, especially in times of economic trouble, which is kind of where this data comes from in 2020. So let's also debunk the sort of Warren Buffett secretary myth. On the right-hand side, the average tax rate for the highest earners is higher than all the other groups. No, the wealthy person secretary does not pay an average tax rate that's higher than her boss. There are exceptions to every rule. Perhaps his secretary is some sort of strange exception. Warren Buffett is one of the 10 richest people in the country, so his situation is certainly unique, but it's a one-off. It's not the case across the country. You can make a political argument, again, not making a political argument. You can make an argument that the rich quintile should pay an even higher rate than they pay today. They should pay an even higher share of the taxes. That's logical. You can argue that the tax burden should be shouldered more evenly across income groups. But one thing you cannot say is that some group, especially top earners, don't pay their fair share, because objectively they are the only people that pay more of their fair share of taxes than they earn in income. So, all right, now that we have that as a starting point, all right, so now that we have that as a starting point, let's talk about this one big, beautiful, hugest, best bill ever to pass Congress and what its impact is going to be on the economy. The reason we start with the economy is because you might get a few $1,000s through some of the tax breaks and the provisions. We're going to dive into some of those details later for things you need to watch out for. But the most important impact for most investors by far will be the bill's impact on the economy and on your portfolio returns. Does the tax bill drive economic growth, or does it hurt the economy? Does it raise interest rates or not? Those kinds of things probably more impactful than the discount that you get from any one particular provision, unless you're doing some really special business investing or things like that. Now, there are lots of strange accounting methods that the federal government uses that no one else in the real world likes to use. Some of those are logical for laws and legal concerns and things. Some are just completely not logical at all. So for this conversation, I think it's easier just to stay grounded in reality. What are tax receipts this year for the 2025 fiscal year? And what will they be next year under the new law? That's what's going to determine whether or not the bill is going to help or hurt the economy, not sort of comparing it to a baseline or comparing it to what the law would have otherwise been had some, strange things happen. It's just what is spending and government receipts this year? What is our spending and government receipts next year? Are they higher or are they lower? And this may surprise you, but the One Big Beautiful bill increases government spending in 2026 and 2027 before cutting it dramatically in the 2030s. It's easy for folks in Congress to cut spending in the out years and not cut spending now because they won't be there probably in the 2030s. The CBO estimates that spending will increase by $19 billion in 2026 from this year and by another $7 billion in 2027. Now, in government terms, that isn't actually sort of a really big increase. So perhaps we'll say that the bill comes close to holding spending flat over the next 2 years before cutting spending starting in 2028. Over a 10-year period, spending does go down, just like the administration claims it does go down by $1.2 to $1.4 trillion, depending on how you do the math, but all of that is sort of back-end loaded. Now, will the budget change between now and 2030? Yes. So I'm not really all that concerned about what happens or doesn't happen in the 2030s. I'm more focused on the next couple of years because that's where this is really going to be impactful. So for the next 2 years, government spending is flat to up just a little bit. Tax collections, however, are down fairly dramatically. Using the sort of standard congressional scoring methodology, taxes are reduced by more than $620 billion in 2026. However, again, this goes back to the mathematical equation. $420 billion of that are really just extending the prior Tax Cuts and Jobs Act that's on the books today. So in the real world, what we will say is that tax collections are going to go down about $200 billion in 2026 as compared to 2025. And that's according to the analysis of the Senate bill done by the Tax Foundation. So we haven't talked about tariffs yet because those aren't part of the official sort of DC spending calculus. In June, the U.S. government collected about $30 billion of tariff revenue. If you just annualize that number, you get to about $360 billion for 2026. Last year, the U.S. imported about $3.3 trillion worth of goods, not services, just goods. If you assume that there's a 10% tariff rate on all of those things, that gives you about $330 billion of tariff revenue on an annual basis. So we don't know where the tariff conversation is going to end up completely, but it feels like that mid $300 billion range is pretty good estimate to work with for now. So spending is kind of flat. Taxes go down by $200 billion in 2026, and tariffs bring in a little bit north of $300 billion. Some of that tariff burden will fall to foreign suppliers, some to U.S. businesses, and some to consumers. We've talked about tariff burdens on other episodes, so I won't dive a ton of into that completely here. But I think it's safe to assume most of that is going to get paid by people in the U.S., whether it's businesses or consumers. But some will get paid by foreign businesses. All of that adds up to about $100 billion drop in the U.S. government deficit in 2026 and 2027. So it doesn't really hurt or help the economy. It's kind of just flattish. Again, when you're talking about, $1.5 trillion deficit this year, that could be as high as 1.7. We're really just sort of going from really high deficits to not changing that. So we're going to have, we have $1.5 to $1.7 trillion this year. We're going to have $1.5 to $1.7 trillion in budget deficit again next year. We're not getting a lot better. We're not getting a lot worse. For all of those that want to hem and haw about what happens to all those trillions of dollars in the 2030s, I appreciate the argument. I do. We need to get spending under control. We kind of covered that in the upfront setup there. But we have 5 Congresses between now and then. They're going to change spending levels. So I think looking out what happens in the 2030s is sort of a waste of time. So I like I said, I do think spending needs to go down. I would support, spending cuts, but that'll be a question for another Congress to answer another day. So kind of a neutral impact on the One Big Beautiful bill for the economy. So let's switch gears a little bit and talk about the tax cuts that are in the bill and things you should think about in your personal situation between now and year end. The biggest part of the tax cuts are simply, like I talked about, an extension of the existing Tax Cuts and Jobs Act from Trump's first administration. So that means a higher standard deduction, they even increased it a little bit more for 2025, and fewer itemized deductions. So that's kind of the regime that we've been living in, and we'll talk about what that means in a minute. But let's talk about some of the more public provisions that you've heard about. No tax on tips, Social Security, overtime, auto loan interest, some of those things. The bill includes a provision that makes $25,000 of tip income deductible. Now, before you go restructure your earnings to be all in tips, they did a decent job of limiting, the number of people that can take that deduction. The IRS is going to define customarily tipped industries. So think service industries where you would likely leave tips today. But if you're outside of one of those industries, newly found tips are not going to be deductible. Also, the deduction starts to phase out when singles earn $150,000 or couples earn $300,000. So again, I probably won't be charging, tips for our services here at Capital Stewards because we're not customarily in a tipped industry, and the phase outs would be effective too. So a lot of folks, Social Security, a lot of folks have been talking about this bill is sort of no taxes on Social Security. That's the talking point. You might be surprised then to find out that your Social Security income is just as taxable as it was before. To avoid what would have been a lot of impacts around sort of Social Security optimization and when to take Social Security and not take Social Security, what they really did in the tax bill is just said, if you're a senior over 65, you get an additional standard deduction. That's around $6,000 for individuals and $12,000 for couples. The extra standard deduction certainly will reduce your taxes if you're over 65, so that's a good thing. But it probably won't fully offset the Social Security taxes that you pay for most of our listeners and clients. Again, if you're not getting a lot of Social Security income, if you're in a really low tax bracket, then that might be different. But if you're earning, close to six figures or more in taxable income, and you are, and you're in that world where 80% of your Social Security is going to be taxed, then this is probably not going to cover the entire tax bill. And of course, when your adjusted gross income exceeds $75,000, the deduction starts to fade out. And by the time, if you're a married couple that's retired, by the time you're $250,000, it's eliminated entirely. So again, they're still taxing Social Security just like they were before. You just get an extra deduction if you're over 65. Let's talk about overtime. That's what I'm doing as I record this. Similar to the tips provision, $12,500 of overtime compensation is deductible. That only applies to the premium portion of overtime, or that extra compensation that you receive for overtime per hour, or that you pay your employees per hour. So if a worker makes $20 an hour normally and $30 per hour in overtime, then the extra $10 would count towards that $12,500 reduction, not the whole $30 an hour that they earned during their overtime sort of work period. So there is some complexity in how that's structured. So if you've got workers that you're paying hourly, that's kind of how that's going to be structured, how it's going to hit their taxes. The last of the heavy hitters is auto loan interest. Up to $10,000 of auto loan interest is tax deductible for new, not used, only new cars when the final assembly of those cars occurs in the United States. And that may get tricky because some Mercedes-Benz SUVs are assembled in Alabama. Some Fords are assembled in Canada. So you're going to need to look at the specific model that you're buying, talk about it with a dealer before you make a purchase if you're planning on using that deduction, and make sure that your new ride was actually assembled in the United States. The brand name may not get you all the tax deduction that you're looking for. And of course, there's a limit to $10,000 in interest, and it starts to phase out at $100,000 for singles and $200,000 for couples. Let's talk about SALT. Whether you think SALT is good policy or bad policy, it's the current law. If you itemize your deductions, which kind of like I said up front is the minority of people, right? Most folks are just taking those standard deductions now. But if you do itemize your deductions, then you can deduct your state and local income taxes. The new law caps that deduction at $40,000 and it phases out when your income's over $500,000. So this is less relevant generally for folks that are in our area in the Southeast. But if you happen to have income from a high tax state like California, if you're a contractor or New York, then you might be able to deduct some of those higher taxes that you pay in other states. So those are a few of the heavy hitters from the tax bill you probably heard on the news. Let's talk about planning ideas for you to put in your brain and think about as you move towards the second half of the year. Some of the things we'll be thinking about with our clients, certainly. The most important thing to remember about the Tax Cut and Jobs Act, and now the One Big Beautiful Bill, the hugest, beautiful, best bill ever, is that it makes the tax code simpler. Higher standard deductions and fewer itemized deductions. I always talk about how the hunt for deductions has kind of gone away. It's harder to find things ex post or in, this year or for last year to reduce your taxes down the road. So if you can't find deductions, the best way to manage your tax situation is to manage your taxable income. That means paying close attention to things like Roth IRA conversions and other strategies that move income recognition from one year to another year to help minimize your long-term taxable income. So if we can't find those deductions, we want to be really specific about when we're taking taxable income, when we're paying those taxes. That is the best way to help us mitigate taxes over the long term. If you're a business owner, there's three things to consider in the bill. some of these are not necessarily new concepts, but there are some modifications. So it's worth revisiting these if these are super important to you. So the first is capital spending and sort of associated depreciation. Qualified business income is the second set of things, and then qualified small business stock. So I'll take those kind of in order. For business owners, domestic R&D can be expensed to reduce your taxes. You also might be able to go back and expense some prior R&D back to 2021. So if you run a business, like say a defense engineering firm in Huntsville, and you've got a lot of R&D happening every year, it might be worth taking a look at that. Bonus depreciation is also back. That means you can fully expense some types of capital expenditures in the first year. This is really where there'll be some help to the economy, because this means probably businesses will do some investment, they'll build some factories, they'll do some CapEx they may not have otherwise done, so that they can go ahead and expense it. So that might cause you to reevaluate your business's sort of capital spending plans over the next couple of years because of bonus depreciation. So it might make more sense to accelerate some of those things, help the economy out, right? And then get immediate tax deductions for them instead of spreading that out over several years. So if you own a small business, you might be eligible to deduct the first 20% of your income as qualified business income. This was a feature of the Tax Cuts and Jobs Act. It's now permanent, at least until it gets changed. The new bill made a few changes to allow sort of more service-oriented businesses to take the deduction. So if you own a business and you couldn't take the QBI deduction before, it's worth reevaluating whether or not that's a thing for you going forward. The same is true for qualified small business stock. That provision was made permanent. That means that up to $10 million of capital gains on the sale of a small business can be excluded from taxes if your stock is structured correctly. So it's vitally important that your business is set up correctly from the beginning. You work on that with your CPA, work on that with your tax advisor. It's worth revisiting that with your tax team if you own a business. Make sure you're still in sort of the green zone for qualified small business stock. And then lastly, from a planning perspective, let's talk about Trump accounts. This bill will allow you to open an IRA for your child, and the government's going to contribute the first $1,000 for kids that are born between 2025 and 2028. Unfortunately, all of our kids are born now. Could have got $1,000. Getting free money from the government's a good thing, but thoughtful planning, I think, is required here before you contribute more funds than what the government's going to put in. You don't receive a tax deduction for money you contribute to your child's IRA the same way that you do to your IRA. So that means you contribute fully taxed money on the front end, and then the distributions are also taxed when they reach retirement age. So depending on what your situation is, you might be better off just contributing to a standard brokerage account or a Roth or something else instead of these new IRAs. So just be really thoughtful before you rush in to open new IRAs for all your kids, and then they have this giant tax bill to pay down the road. So, all right, let's summarize it all together. So the fiscal policy of the administration, all together, our view is it's kind of neutral to slightly positive for the economy. Not a huge stimulus bill, but not super negative either. Overall, from a tax planning perspective, I think continuing to control your income remains the most important thing for you to think about. There's fewer itemized deductions. So it's really all about thinking about when you recognize income and planning for that years and years ahead of time so you're in control of that and you don't lose control of it. Many of you are going to get a little bit of tax help from the senior citizen deduction, perhaps the ability to deduct auto loan interest. So those are good things to watch out for as we get into next year. And then lastly, if you own a business, you want to reevaluate your qualified business income, QBI, qualified small business stock, QSBS is the abbreviation there. So reevaluate those things if you own a business. So, and then lastly, like I said, before you rush into opening an IRA for your child and get hit with taxes twice, just be kind of thoughtful about how you do that. So I hope this helps put some of the provisions from the bill in context. We'll be back later this year with tips for year-end tax planning, just like usual. So watch out for that, and we will see you on the next episode of the Capital Stewards Podcast.